Hello everyone, you're welcome to the first module of this course, Financial Accounting. And in this lesson, we're going to be looking at Introduction to Financial Accounting. Under this topic, we'll be looking at what is financial accounting, why is financial accounting important. We're going to look at the key features of financial accounting. We're going to look at how financial accounting works. We're going to look at the principles of financial accounting. So first, what is financial accounting? Financial accounting is the process of recording, summarizing, and reporting a company's financial transactions and performances through financial statements, primarily intended for external users like investors and creditors. Another way to look at financial accounting is a specific branch of accounting that focuses on recording, summarizing, and reporting an organization's financial transactions over a period of time. Its main purpose is to provide useful and financial information to external stakeholders such as investors, creditors, regulators, and tax authorities. It is also a specific branch of accounting that involves the process of recording and summarizing and reporting. So if you pay attention, you will see a recurrence of three words, which are recording, summarizing, and reporting, right? So these transactions are summarized in the preparation of financial statements, including balance sheets, income statements, and cash flow statements that record a company's operating performance over a specified period. Work opportunities can be found for a financial accountant in the public and private sectors, and a financial accountant's duties is different from those of an accountant who works for clients, preparing for their accounts, tax returns, and auditing other companies. So we have established that financial accounting is a branch of accounting, which means that there are various branches of accounting. So now that we've had an understanding of what financial accounting is, we're going to be looking at why is financial accounting important. So companies engage in financial accounting for a number of reasons, and so we have one, creating a standard set of rules. By delineating a standard set of rules for preparing financial statements, financial accounting creates consistency across reporting periods and different companies. We're also looking at decreasing risks. Financial accounting does this by increasing accountability. Lenders and regulatory bodies, tax authorities, and other external parties rely on financial information. Financial accounting ensures that reports are prepared using acceptable methods that hold companies accountable for their performance. Another reason for financial accounting is providing insight into management. Even though we have other methods such as managerial accounting, that provide better insights, financial accounting, it drives specific concepts or strategic concepts that help a company analyze its financial results and makes reactionary investment decisions. So a company can look at their results and see where we need to improve upon, and knowing this and understanding this will help them make better investment decisions. Another important reason for financial accounting is promoting trust in financial reporting. Independent governing bodies oversee the rules of financial accounting, making the basis of reporting independent of management and a highly reliable source of accurate information. Another reason is encouraging transparency. By setting rules and requirements, financial accounting forces companies to disclose certain information on how operations are going and what risks the company is facing, painting an accurate picture of financial performance regardless of how well or poorly the company is doing. Now we will be moving on to the key features of financial accounting. So financial accounting is historical in nature. It did not just start today, it has started since way back. It is structured by accounting standards. It follows a strict framework of rules and guidelines known as generally accepted accounting principles or international financial reporting standards to ensure consistency, accuracy, and comparability across businesses. And we'll be looking at these standards in future modules. And double entry system is the third. Financial accounting uses the double entry system, meaning that each transaction affects at least two accounts, the debit and credit accounts, which help maintain the accounting equation. So we're going to look at this in future modules. And then we have financial statements. The output of financial accounting includes the preparation of key financial statements. And under that, we have income statements, we have balance sheet, we have cash flow statements, we have statements of changes in equity. Another feature is external focus. Unlike managerial accounting, which is for internal decision making, financial accounting is meant for external users who need reliable and standardized financial data to assess a business's health and performance. Now we'll be moving on to the objectives of financial accounting. The objective of financial accounting are as follows: to maintain a systematic record of financial transactions, to determine profit or loss during a specific period, to provide a true and fair view of the company's financial position, to ensure compliance with legal and regulatory requirements, to aid stakeholders in making informed decisions. And here, there's an example, but you can read further on that in the notes that will be given. So, how does financial accounting work? Financial accounting uses a series of established principles, as earlier mentioned. The accounting principles used depend on the business's regulatory and reporting requirements, because each business has their own different regulatory and reporting requirements. Companies and organizations often have an accounting manual that details the pertinent accounting rules, as I mentioned. Right. So for US companies, they're required to perform financial accounting in accordance with the generally accepted accounting principles. Their purpose is to provide consistent information to investors, creditors, regulators, and tax authorities. And the statements used in financial accounting cover 5 main classifications of financial data and financial accounts, which are revenues, expenses, assets, liabilities, and equity. Revenues are income from sales and products or services, plus other sources that include dividends and interest. Expenses are the cost of producing goods and services, from research and development to marketing to payroll. Assets are owned property that could be tangible or intangible. For example, there could be buildings, computers, trademarks, that's on the intangible side, patents, and stuff like that. Then for liabilities are outstanding debts or loans or rent. And equity, if you've paid off a company's debt and liquidated its assets, you would get its equity, which is what a company is worth. Quickly, let's look at the principles of financial accounting. Financial accounting is dictated by 5 general overarching principles that guide a company on how to prepare their financial statements. And there are 5 of them, which are the revenue recognition principle, we have the cost principle, we have the matching principle, we have the full disclosure principle, we have objectivity principle. So thank you very much for watching this module. In the second module, we'll be learning about the methods of financial accounting. We'll be learning about the different standards of accounting that we have, like the general acceptable standards and the IFRS. Thank you and see you in the next class.